Ben Bernanke is boring his audience with his predetermined remarks. We know what he's going to say. We're waiting for the Q&A, and you will get it when he starts it. Meanwhile, I am joined by my colleagues. Ed Butowski, he pops up on the screen there. So I'm going to ask everybody the same question. Is the stock market rally, the Dow at 15,500, is that because Ben is printing money? Ed Butowski first.
No, it's not. You'll have short-term moves based on what he says, but the reason stock prices are higher is because corporate earnings are coming in fairly well.
That's it? That's all you got to say? It's nothing to do with it. All right.
Well, I got a lot more.
I know you do.
I thought we were doing a quick
lightning round.
Quick thing. I mean,
it is.
I thought it was a lightning round. I apologize.
It is a lightning round, and I confused everybody. So, Melissa, is this rally because of Ben Bernanke printing money?
Absolutely. I couldn't disagree with Ed more. That is absolutely what it's all about. It's about easy money out there, and you saw immediately when there was a hint that he might cut back a little bit, we saw the stock market really falter. Without question, this is a market that can't stand on its own 2 feet. When the training wheels come off, we're in big trouble.
Fed critic you
can promote me from judge to justice. I'll accept that promotion. Some of my colleagues wouldn't.
Not that you know anything about Wall Street, but is this rally the result of Ben printing?
I am not as qualified as my colleagues to opine on this, but it is obvious even to any viewer of the scene. Wall Street is drunk on free cash.
Yes.
And to the extent that Ben has given it to them and that they think he will give it to them into the future, they'll borrow it, they'll buy it, and they'll spend it.
You agree with that analysis, Ed Butowski?
No, and Melissa, let me say, short-term moves you're going to see because the markets are driven by computer programs and they're set up and they're going to have moves and you're going to see them go higher and you're going to see them go lower in the short run. But in the long run, Melissa, there's no dotted line, and I'm begging for anyone to prove to me there's a dotted line between printing of money and corporate earnings. Haven't seen it on any show anywhere I've watched.
Well, because we haven't seen any real growth in the economy. I mean, that's not what's spurring the stock market right now. I mean, you see corporate profits go up, but not revenue. There isn't money out there to be spent right now. We aren't seeing
I don't want to get too into the weeds as the least qualified. But you asked about the stock market. You didn't ask about corporate earnings.
No,
I
didn't.
Talked about that number we see on the board.
Market.
Well, hold on a second. Let me just refer to everybody here. Ben Bernanke is printing money. He is deliberately keeping interest rates absolutely near zero, flat down. Think about it.
That doesn't affect it.
It does, because that...
No, the printing of money doesn't affect interest rates.
If you put interest rates all the way down, it means that if you buy a bond, your rate of return is useless. It is virtually zero. So buying bonds is not very attractive. By contrast, buying stocks is very attractive because your rate of return is much better. Anybody with any money has to make a choice. Put it in bonds, put it in gold, put it in stocks. With interest rates at near zero, you put it in stocks, not bonds. Go ahead,
But the discount rate and the Fed fund rate is set by policy, not by printing of money.
Okay, but the part of the Fed policy is to keep the federal funds rate and the discount rate way down there. It does affect the stock market.
I completely agree with that.
It's all of their policy. It's all their policy that is driving investors into the stock market. Ed, from semantics, you're right. I think we're talking about their policy in general, that keeping easy money flowing, however you define that, whether that's through their bond buying program or whether that's through low interest rates, has forced investors in the stock market. It's also juiced the housing market. And you have to wonder, as we watch the 30-year rise, what is going to happen to those home buyers? Initially, you see people get into the market because rates are going up, but then it's going to kill the housing recovery, and that's not good for the stock market.
The judge is next.
What is the inevitable consequence of artificially low interest rates? A bubble. That's exactly what's going to happen, because at some point they're going to have to rise to their natural rate, and no one will be equipped to pay those rates because they're used to getting this free money.
Last word, Ed, before we go to the break.
Well, I mean, the difference, Melissa, is very important because the printing of money does not push the short-term interest rates lower, and it's really affecting on the long end. And I look at corporations, I talk to corporate CFOs and CEOs, and the printing of money does not benefit them unless you're a bank. And banks are moving the stock market higher.
I think Stuart already ceded that point to you. We're talking about policy in general. His entire policy right now has created an artificial rise in the stock market that I'm afraid is going to go away when they back off, if they ever do.
All right, everybody.
At this point, we'll see.
We've got some fireworks around the set here in New York and in Dallas. We're looking for fireworks in Washington because